The Islamic capital market is expanding rapidly, moving trillions of dollars globally. At the center of this financial network sits Malaysia, establishing a robust framework for ethical investments. But this market operates under a strict set of non-negotiable rules. To participate, an investment must be free of riba, or interest. It cannot involve gharar, meaning excessive uncertainty, and it strictly forbids maisir, which is gambling. These restrictions are designed to force capital away from exploitative financial engineering and direct it toward tangible, productive economic activities that actually build physical goods and services. The result is a market structure that prioritizes long-term stability and social fairness over the pursuit of sheer, unchecked profit. Look at how the conventional stock market operates. When analysts screen a stock, they typically have a singular objective, identifying financial growth to maximize returns for the shareholder. They rely on a standard set of metrics to decide a healthy company. They check the earnings per share, calculate the return on equity, and measure price-to-earnings ratios. But this approach has a significant blind spot. A corporation can display a flawless balance sheet and spectacular profit margins while generating its revenue through activities that cause severe societal or environmental harm. To address this, the Shariah Advisory Council of Malaysia, or SAC, developed a rigorous two-tier screening funnel. This system is built to protect the broader ethical objectives of Islamic law, known as Maqasid al-Shariah. By enforcing strict religious and ethical filters, the SAC requires investors to evaluate exactly how a company's money is made, rather than simply measuring how much of it there is. The first tier of this funnel is the qualitative assessment. This is an immediate filter. If a company's primary business involves conventional banking, alcohol production, gambling, or pork products, it is rejected outright. Even if a business passes every financial test, the SAC will classify it as non-compliant if its operations cause broad damage to society or the environment. However, modern global conglomerates rarely operate in just one sector. Many mix permissible, or halal, operations with restricted ones. For these companies, the SAC applies the quantitative assessment. This document outlines the exact benchmarks used in that assessment. For core prohibited activities, like conventional lending or liquor sales, the revenue generated cannot exceed 5% of the company's total revenue or profit before tax. Further down, the guidelines establish a 20% benchmark. This applies to secondary, mixed activities that are generally acceptable but contain some non-permissible elements, like hotel management or conventional stockbroking. If income from these areas crosses 20%, the stock fails the screen. These specific percentage thresholds are highly practical. They give large companies a realistic operating buffer to navigate complex global markets without violating the core principles of Islamic law. The final stage of the quantitative funnel moves away from revenue and examines the balance sheet using financial ratio benchmarks. Here, the SAC measures a company's reliance on interest. This page details the two major financial constraints. The first is the cash over total assets ratio. This dictates that the amount of cash a company holds in conventional interest-paying bank accounts must be strictly capped at less than 33%. They ensure that even if a business's daily operations are perfectly permissible, it cannot secretly become dependent on prohibited interest-based financing to stay afloat. To see how these filters change investment choices, consider Malayan banking Berhad, or Maybank. From a purely conventional perspective, it is a highly profitable blue-chip stock. But because its primary business relies on conventional interest-based banking, it instantly fails the SAC funnel. Now look at this matrix comparing Maybank against Tenaga Nasional Berhad. TNB shows strong financial health, clearing the conventional hurdles, while also passing the strict qualitative and quantitative Sharia rules. It survives the gauntlet. Many investors look to environmental, social, and governance, or ESG, screening as an alternative ethical standard. But while ESG focuses heavily on corporate sustainability, it completely ignores the religious compliance of the underlying business activities. Alternative strategies like ESG and value investing are highly useful tools. However, for the Islamic investor, only the SAC methodology provides a complete, uncompromising ethical filter. Maintaining a Sharia-compliant portfolio does introduce specific frictions. The first major challenge is the lack of global standardization. Because institutions like Bursa Malaysia, FTSE, and the Dow Jones use different interpretations and thresholds, a single stock might be rated as compliant in one market and non-compliant in another. Additionally, untangling the exact sources of non-permissible income within massive multi-sector technology conglomerates requires detailed, labor-intensive forensic accounting. Once a stock passes the screen, the work isn't over. A sudden shift in a company's debt levels or a new subsidiary acquisition can instantly strip away its Shariah-compliant status. Shariah compliance is never a permanent guarantee. It is a fragile, moving target that demands relentless, continuous surveillance. To address these vulnerabilities, regulators must push for the global harmonization of screening standards. Aligning these rules across borders will eliminate confusion and significantly boost international capital flows. At the same time, the market is turning to technology. By integrating artificial intelligence, compliance systems can instantly process massive corporate datasets, moving the market from periodic reviews to real-time compliance monitoring. Beyond technology, explicitly linking Shariah principles of social responsibility with global ESG goals presents a unique opportunity. It aligns perfectly with a growing demographic of socially conscious, non-Muslim investors looking to enter the Islamic capital market. The Shariah screening gauntlet undeniably restricts the total pool of eligible stocks. But by prioritizing ethical governance and severely limiting debt, it creates a highly rigorous, future-proof framework for transparent risk management in the modern economy.